We have 5 stocks to analyze to see if they have potentially big upside potential. Let's go analyze them now. Stock number 1, PayPal. This is a stock that is an emotional train wreck for a lot of people. Here's why. All-time high on July 26, 2021 of $310, almost 3 years ago. And look at the stock price. It has just gone this way. Now, this is a stock that's talked about a lot in the Value Investors Club. It's a stock that's getting a lot of criticism. That's what makes me like it. And the reason being, it is considered dead. If you look at the revenue, though, dead company I do not see. 17.8, 21.5, 25.4, 27.5, $29.8 billion in revenue. Now, they do have declining users, but the average transaction value per user is up and up a lot. I don't like the fact that they have less users, but they are working to turn that around, I am sure, or generating more revenue per user. Venmo is owned by PayPal, and Venmo is a verb. Venmo me. Do this. Venmo me. I love that. Here are the analyst estimates on PayPal. $5.60 per share in profit this year, $6.23, $7.13, $8.09, $10.68. Guys, look at this growth. 11%, 11%, 14.5%, 13.5%, 32% revenue growth. Keep in mind, these are analysts. They have a lot of bias themselves, but for a stock being that down, almost 80%, over 80% at one point, to still have a lot of growth potential given by analysts on EPS, that's wonderful. Let's look at their revenue growth potential according to analysts. 32.6, 35.5, 38.5, 43.5, 51. Growth of 8%, 8.5%, 8.5%, 13.5%, 17%. How is this a dead company? They haven't done these results yet, so you got to keep that in mind. And also, I own PayPal. I have a bias here. Don't buy a company just because I have it or just because somebody on the internet has it. I'm here to teach a process that you can apply to your own investments. This value investing approach can be applied to real estate, stocks, businesses, whatever you want, but you've got to focus on the companies that make the most sense to you. This is what I was talking about earlier. The value of payments, percentage compared to the previous year. Look at the growth. Total value in billions of dollars. Growth every single year. Big growth, small growth, medium growth, higher growth, all these things. Guys, it's not going to be a straight line up, but there will be growth, in my opinion, because PayPal is a trusted transaction facilitator for people, especially internationally. Whenever I order something that's high dollar or something that I want to protect, I always use my PayPal. I don't even use my credit card. I use my PayPal account. Now here are the total users by quarter. As you can see, decline. This number went down below 0. It is a decline, and that is a concern. Hopefully, they're either getting rid of useless users or trying to refocus to get that growth back up with higher quality users. Now, the biggest thing with PayPal before we do our stock analyzer tool is that emotional ride from $310 all the way down to $50 at one point. That's rough. And if you bought it at $310 and you're wondering yourself, oh my gosh, remember, your $310 purchase is done. You've got to focus on, is this the right company? We get too attached to what the stock has done versus what it could do. Remember, if you liked it at $310, you should love it at $50. You should love it at $60. Why? Because they have more revenue, more profit. Everything is better in the company versus when it was $310 3 years ago. That's the main key here that I'm trying to teach on this channel. Keep that in mind when we're talking about things. It is hard for me too. I get attached to, oh my God, I bought the stock at 150, now it's at 75. Peter Lynch has said, I bought stocks at 12, they went to 2 before they head to 50. That's what makes someone an investor and not a speculator, when they're looking at the price relative to the value. When value is much greater than price, you should want to buy it even more. If you started buying it here and value and price started to deviate like this, you should want to buy more as long as the thesis is similar or the same. Now, here's the last time I did PayPal in our stock analyzer tool. I did a 10-year analysis. I did 4, 7, and 10% revenue growth. I did profit margin of 12.5, 15.5, and 18.5. And I did free cash flow margin that was higher. Because if you look right here, their last 10, 5, and 1 year free cash flow is higher than the corresponding net income. That's a big positive for the company. Now, PE, 10 years from now, I did 13, 16, and 19. And the reason I went there, I'm wondering if my bias towards seeing the stock fall has driven that. Even though I've done well in the company, dollar cost averaging as it went down, I look at this going, yeah, but there is a lot of competition in the payment transaction space. And for that, I want to hedge a little bit here. I did a 9% return here. Again, If you want to buy an individual company, you got to have higher than the market 9 or 10%. Why? Because it's an individual company. If you just want to match the market, buy a low-cost ETF. But you're watching this video because you want to beat the market. And you want to apply that process in order to beat the market. I just put 9% in here to show hey, this is the market value of it if you want to match the market. But for you, when you have the software and people who have the software, put in a much higher number. But I can't determine that number for you. Why? Because you might know PayPal a lot better than I do, so your number should be lower than mine. But right now, I'm just going to focus on the market return. I hit the Analyze button. I have a low price of 55 to 70, high price of 160 to 200, a middle price of 95 to 125. I have my watch list, only 55 because I want to be notified so I can add more shares at that price. But I'm actually going to change that to 60 right now because I think it's an adequate price to sit there and notify me going further. Stock number 2, one of the best software businesses in the world, Adobe. And the thing I love about it so much is it is down a lot. Last 6 months, down 21%. Year to date, down 17%. 3 months, down 11%. I love that. And you should too. That's what I'm trying to teach on this channel. That if you buy for the right fundamental reasons, but holding or buying more is based on the emotion, you got to be able to look at this as an opportunity. I get excited seeing this thing fall. And I sold puts recently to try to buy this company at lower prices. I won't get into what that means now, but basically I'm being paid to buy the company at a lower price at a future date. So if I don't get the shares, I still got paid for it. If I get the shares, I got it at the price I wanted. So let's go check out some more on Adobe. Look at the income statement here. Look at this growth level. 5.8, 7.3, 9 billion, 11.2, 12.9, 15.8, 17.6, $19.4 billion. Guys, this is a company that dominates with Adobe Photoshop, Adobe Reader, all these things that are incredible, and their subscription model is working so well. So instead of buying the CD for $300 and having it for years, you now get to pay a monthly fee, and now you get to get all the updates, all the great technology as time goes on. This is incredible. Let's look at their profit growth over the last X number of years. 1.2, 1.7, 2.6, 3, 5.3, 4.8, 4.8, 5.4. Now remember, guys, look at this. If you were sitting in 2020 at 5.3, then you saw 4.8, then 4.76, you might have been scared, going, oh my God, what's happening? It came back. Great companies might invest short-term to get bigger growth down the road. Those are the companies you want. Look at Adobe's research and development costs from 2010 to 2023. Look at this growth. I love it. I haven't run this as a percentage of revenue, but I'm quite sure that this will probably be in line with revenue growth, maybe a little bit better, but they're investing in their products. That's what I freaking love. Very similar chart, sales and marketing expenditure from 2010 to 2023. Boom, $5.4 billion in 2023. Remember, look at what they did in 2023 in sales. In total sales, $19.4 billion. They spent over a quarter of that on sales and marketing. So let's check out the 8 pillars on them. Guys, 2X's, valuation. Now, one thing I love, they have more free cash flow than earnings. That's why the multiple for free cash flow is lower. And if you look down here, the 5-year free cash flow is $6.15 billion. The 5-year net income is 4.6. They're showing more free cash flow than net income. I love that. These are X's, but guys, does it mean they're actually a bad value? If a company can drive a lot of profit, because look at their gross margin here, 88% gross margin, every extra dollar they sell, 88 cents has the potential to go to that bottom line. That's what you want in a company that can grow their earnings fast. That's amazing. Return on invested capital, 20% over the last 5 years, 24% last year. They get a great return on the money invested in the business. So for me, I'm not fully sold that it's massively overpriced here at what these numbers show. Look at analyst estimates. EPS growth, 12.6%, 13.5%, 15, 11, 14.5%. Big time EPS growth. Let's look at revenue growth. From $22 billion to $35 billion in the next 4 years. Double-digit growth every single year. This is a company to pay a premium for. The question is, what's the right premium? So let's go to our stock analyzer tool. Now, guys, you look at this company also just like PayPal. It's off its highs. $6.99 from November of 2021. The low recently, last year of $3.61. That's almost a 50% drop. Could you have had the ability to add shares to that as it fell? That's what's going to make you a great investor. Investing is scary because of that emotional part. I get scared. Everyone gets scared from it. But if you buy for the right fundamental reasons and you have the right people around you, you're going to do better. That's why we created a community of thousands of like-minded investors. So if you want to join this community, this inside group of people who can sit there and do a better job of handling their emotions, click the link below, sign up. I guarantee it's going to change the way in which you look at money. And the extra added benefit is you get all of our tools in this dropdown as part of the community, all for free. So go sign up now, check it out. But let's do our stock analyzer on Adobe. The last time I did it, let's pull up my last search on Adobe. I did 6, 10, and 14% revenue growth. A little aggressive for 10 years, but we'll see how it looks. Profit margin, 26, 29, 32. I actually think that's low. They did 29% in the last 5 years, but that 88% gross margin could allow them to really drive that profit even faster. Free cash flow, I did 38, 40, and 42. Higher than the last 10 years. For PE, now guys, the PE here, I did 15, 18, and 21, same with price of free cash flow. If you were out there and you said to me, Paul, I think this is a 25 PE company, I don't know if I disagree with you. I look at that going, it's a top quality business, but that's what makes investing an art. How do you determine what PE to place here? I don't know. Warren Buffett paid 30 times earnings for Coke and made 11.5% since 1987, starting at 30 times profit. Could I see 18, 21, and 24? Sure. Let's make it that. And again, my 9% desired return. Boom. Low price of 240 to 350, high price of 680 to 900, middle price of 400 to 570. Is it ready? Guys, according to free cash flow, is this enough margin of safety? Almost 20% margin of safety on this price. That's something for you to determine. Stock number 3, Johnson & Johnson, the good old J&J. So this is a company that pays a nice little dividend here, which is very attractive for a lot of investors, 3.2%. It eats up $12 billion of their $18 to $19 billion a year of free cash flow. That's 66%, if not more, of their free cash flow. Now remember, I know a lot of people love the dividend. I don't blame you, but it should be the last thing they do with their money. I see a PE of 9.5. I see a price of free cash flow of 20. Obviously, this PE of 9.5 is based on a $38 billion net income, which is significantly higher than the free cash flow. So there was probably some sort of accounting adjustment that made this profit a lot higher. But even then, 20 times PE, price of free cash flow, 17.8 times 5-year PE. Maybe they should be buying back shares. I don't know. But dividend, 3.2%, seems not very fun. All-time high, 2 years ago, $186. It's currently at $151. 52-week low just last week of $143. Now, we look at Johnson & Johnson, 8 pillars. I mean, the cash flow is down from 5 years ago. There might be a very specific Actually, let's go look at it right now. Cash flow. All right. It just had a really good year, but it's been pretty consistent. Look at this, guys. 14, 15.3, 16.5, 18.4, 18.5, 19.8, 20.8, 19.7, 16.2, 18.3. This is just your clipping on away. And I'm sure Johnson & Johnson's revenue is going to go up with inflation. Let's see what those analysts are saying about revenue growth. Yeah, look at this. 2.7, 4%, 3.5, 3.5, 2.7. This is probably going to grow with inflation or with nominal GDP growth. It's not going to be anything to write home about. Earnings, same thing. I'm actually surprised. I would have thought a faster earnings growth than this. 7.8, 4.3, 3.1, from 1079 this year to 1270 in 4 years. Nothing exciting, but remember, price is what you pay, value is what you get. If you buy something cheap enough, and for a company like Johnson & Johnson without much growth, you got to buy it reasonably cheap, but it's got staying power. It's got a lot of brands to it. It's got a lot of positives that can really last the test of time. This is a company that you might want to sit there and maybe the lack of growth is offset by the fact that it's just a staple in our economy. Let's go check out the stock analyzer tool. The last time I did it in our videos was April 25th. Okay, I did 2, 3, and 4% revenue growth. Profit margin, as you saw, it was skewed heavily by last year, so I'm eliminating that. Oh, I did 18, 21, and 24. And for free cash flow, I did 19, 22, and 25. Even with last year's big jump of 38%, 42.3%, it still didn't make its profit margin the same as free cash flow. We love the fact that free cash flow is better. We love that, remember. PE, I did 17, 20, and 23. Seems reasonable. The market average is 15. Does Johnson & Johnson deserve a premium? I think it does. And I did 10, 11, and 12%. Let's go back to my 9% across the board for my essential intrinsic value. I have a low price of 100 to 105, high price of 190 to 200, middle price of 140 to 150. So I want to buy it sub 140. Remember, these returns include the dividend. Stock number 4, very exciting stock, Ulta Beauty. Ulta Beauty could be similar to AutoZone, NVR, O'Reilly Auto Parts, the guys who buy back shares a smart way. If they're able to buy back cheap shares, then they're going to drive a lot of shareholder value, and that's what I love. Now, one thing I don't like about Ulta, the free cash flow last year of 1.04 is lower than net income, but the 5-year free cash flow, 911, never forget, is greater than its 5-year average net income of 880. So it offsets each other. Very high return on invested capital, good business, growing same-store sales. That's what I love also. It's a retail establishment, but they have growing same-store sales. I love that. They're going to be cautious about their growth. They're going to grow the smart way from what I have seen. Again, do your own research on that. I have puts on Ulta Beauty at lower prices, but let's go check out the 8 pillars. 8-pillar thriller. Remember, just because it has 8 pillars doesn't mean you buy it. 8 pillars are about telling a story. What does the story tell about the company? There's 8 check marks here. Is that a good thing? It's a bad thing. Buying back a lot of shares, I will say, if they take a downturn, it'll be really indicative to me to see what they do with their cash flow. An example of a company I used to own, Sleep Number, I didn't like the way they managed their cash flow. I sold the company to loss, and I said, you know what? They don't buy back shares at the right time. I sold because I've realized that looking at history, and I'm like, oh, please don't do it again. And sure enough, the stock fell, and they cut their share repurchases. And I said, oh my God, Sleep Number, what are you doing? Plus, I reached out to them 2 or 3 times in investor relations, never got a phone call back, never got an email back, and that bothered me. But either way, that's what it is with Ulta Beauty. Let's look at analyst estimates. EPS growth, 26 a share to 43 a share over the next 5 years. 11, 5.7, 8.5, 13, 15, 11.5%, according to analysts out there. Revenue growth, pretty good for a retail establishment. Mid to high single digits. Okay, not bad. So again, let's go to that stock analyzer tool. I did 4, 6, and 8% revenue growth. Profit margin, 9.5, 10.25, and 11. Same with free cash flow. PE and price of free cash flow, 15, 18, and 21. High returns on invested capital. Smart growers of the company, not trying to overgrow, it seems so far. I did 9% return. Hit the analyze button. I got a low price of 360, high price of 700, middle price of 504. I have some puts on Ulta. Should I be buying it now at 380 versus the 500 here? I really hope I don't regret not buying some, but we will check it out and see. Final stock, another stock that I own, the Star Bizzle, Starbucks. Guys, people love their Starbucks. People want to own their Starbucks. Company has gone nowhere for quite a while. July 23rd of 2021, it was at 126 a share. Just 2 weeks ago, hit 71.80 in a big fall for them. And they're currently at $77.72. I own Starbucks. I bought some on the big fall. Again, don't buy anything because me or anybody else on the internet here to teach a process. Dividend yield, 2.8%, eats up a big chunk of their free cash flow. Now, last year's free cash flow was $4 billion. The 5-year average is $2.8 billion. If they're able to continue growing this dividend is fine. Absolutely fine. If it goes back to the 5-year average, I'm going to have a problem with this dividend, right? Now, Starbucks has been hit hard from sales, and they are still selling for 20 plus PE and 20 plus price free cash flow. Tell me what you think of the brand. I really look at it going, this is a great brand, offset by some news recently, some international growth. First time in a long time they had overall company store sale decrease. That is a problem. I I'm a big believer in everything reverts to the mean on major companies. If you told me right now Starbucks would be gone in 10 years or would be drastically smaller, I'd be very surprised. Doesn't mean it won't be. But I look at Starbucks as a great brand. I think it's a legalized drug. I love it for that reason. And I think to myself, people aren't just going to give up Starbucks. There have been, since Starbucks came out, there have been hundreds and hundreds and hundreds of coffee lines that have come out. People have Keurigs. That's brand loyalty. Really high returns on invested capital. 47% over the last 5 years, 54% last year. Check out the 8 pillars. I don't think it was that great on this company. 3 X's. I'm not worried about the debt. A lot of leases. But you got X's on the 5-year PE and the 5-year price of free cash flow. I do not like the fact that 5-year net income is a lot greater than the 5-year free cash flow, but I'm betting on a brand here, and I think that brand is okay. Analyst estimates, very healthy growth for EPS, 420 to 804 over the next 4 years. 19%, 17%, 16, 20, and 17% growth. Big time growth in their earnings per share. And if the stock falls, continues to fall, buying back incredible shares. Revenue growth, look at this. High double digits, basically 10% across the board. That's incredible. For such a big company with 35,000 plus stores, still growing, still able to grow their revenue and their earnings per share. I love that. So that's what it translates in our stock analyzer tool when we pull up Starbucks. From March 14th, 6, 8, and 10%. Okay, not bad. Maybe aggressive. Maybe I should do 5, 7.5, and 10. Actually, let's do that. Let's do 5, 7.5, and 10. Profit margin, 10, 11.5, 13. Keep in mind, they averaged 12.5 over the last 10 years. 13.5% free cash for the last 10 years. I'm still going conservative. So let's change these a little bit. Let's go 10.5, 12, and 13.5. For free cash flow, let's do same thing, 10.5. Now let's do 10, 12, and 14. PE, I did 17.5, 20, and 22.5 for both PE and price of free cash flow. Guys, you're thinking here right now, is that reasonable? I always base it on the brand and the growth potential. Great brand, actually pretty decent growth potential too, if you look at the revenue and things like that. So I look at it going, I could justify a higher PE. 9% annualized returns. Guys, don't forget, sign up for the community, click the link below. And after this video, once I get to the stock analyzer values, if you want to see in the next video with showing another 5 stocks with a potential of 772% returns, make sure you click the next video. Boom. 60 to 62, 150 to 155, and basically 100. Guys, I think this is a nice discount to value. That's why I own shares. Thank you very much for your time.